Michael sent this question in to us. She's probably 2 weeks ago and said, hey, I'd love for you guys to do a show specifically on this. So thank you so much, Michael. So here's what Michael pointed out in the email he sent to me. He said, listen, according to Redfin, the percentage of homes that are purchased by investors has gone up super high. Should I be concerned that if the market should take a turn, that these investors who are buying based on returns on investment all of a sudden would say, hey, this isn't worth it for me, and then dump their properties? And could this crash the market? Maybe that's a question that you all are thinking out there. So I first wanted to dive into the data, and then I'll give you my thoughts on it. So I looked at the Redfin report that Michael sent over. Here's some of the data coming from that report. 20% of the purchases in the first quarter of 2022 across the entire United States were investor purchases, according to Redfin.com. And so this is up from 16% in 2019. So you're seeing an increase in the type of buyer, according to Redfin, from 16% to 20%. That's nationwide. But he's got a lot of homes with us here in Jacksonville. And if you look at Jacksonville, the percentage actually has gone up a lot more. So the percentage of investor purchases in Q1 of 2022 is 32%. And that's up from 20% in 2019. So Michael's saying, hey, listen, it's great that people are buying in Jacksonville, investors are buying in Jacksonville, but what happens on the flip side? If the market should crash, which I don't think it's going to, but if it should, would this contribute to a crash? Could I be in a place where my investments are not worth what they're worth today because of this phenomenon? So a couple things to clarify. I dove into the data. According to Redfin, an investor purchase is just simply the entity that purchased it. So there are a ton of individual investors who happen to buy in a company name. Okay. So that would lead to this 32% number in Jacksonville. It is a lot of individual investors buying in a company name, which is important to note. Here's another thing. I think all of us are kind of lumping in this like Wall Street buying idea, and there is a lot of animosity of Wall Street coming in and buying anything, but it happens to be a lot of single family rentals. And when you think of like Wall Street buying a bunch of single family rentals and you hear that 32% of purchases are investor purchases, we tend to think that a third of the homes that are purchased are by Wall Street. Well, I dug more into the data, and that's actually not the case. According to John Burns, roughly 3% of the homes in the entire United States that are single family rental properties are owned by institutions or Wall Street investors. These would be, they classified as any institution that owns over 1,000 properties. Just 3% are owned by Wall Street. This 32% that you're hearing, again, is a lot of individual decisions that are made in a company name, or they are smaller real estate investment firms. JWB would be one of those smaller real estate investment firms. Of course, we buy that in a company name, but we are not Wall Street. And so I think it's important to kind of differentiate that. How's that all landing for you?
I like that you clarify data locally. And as I hear the rest of it, it sounds like more people like us are flooding to this asset class the same way that we're doing it. Still doesn't change the idea that what is the effect of people buying homes that don't plan to live in them going up in percentage of homes owned inside of a market versus the people that plan to live in a home, owning them, being the dominant percentage. I would love to address that piece and how you think of this idea of whether it's Wall Street or not, there still seems to be an uptick in investor ownership versus homeowner ownership in Jacksonville.
There's a couple of different ways that we're going to go about answering this question. Is it good or bad? Still is out there, but at least we're identifying that it is thousands of individual investors making a decision on thousands of properties rather than one or two or five people sitting in an ivory tower in Wall Street affecting tens of thousands of properties. That's not what's happening across the country, even though you are seeing Wall Street get more and more involved in that. But your question is still there, and Michael's question is still there.
Yeah, and I guess if what I'm hearing then from what you're saying, then I guess it's like, okay, it is not the same risk of, we talk about diversification as investors, right? So like diversification of investors is probably a solid thing for a market as opposed to just like one or two or three players controlling the whole thing. Is that kind of where we take away from the difference in those statistics?
Yes, exactly.
Okay.
If your fear is that all of a sudden somebody's going to make a decision that this investment is not worth it for them anymore, and they're going to start selling their properties en masse, and that's going to crash the market, you would have less risk if there are thousands of people making that decision versus just one person. And so gives a little bit more context that it's not just that one person or five people. And so that limits the risk, just like you said.
Cool. Okay, continue.
Yeah. So, but the question still remains, there is more investor activity, even though it is spread across thousands of decisions here in Jacksonville and across the country. Is that a good thing or a bad thing? I think for this question, we have to look at why are those investors making those decisions? Because if I put myself in Michael's shoes or in anybody's shoes that was investing before the Great Recession, we understand that if there's a lot of investor activity and they are speculating and they are hoping that prices go up, and then all of a sudden they don't go up, those thousands of people all still could make that decision to sell and potentially drop the market. So I think we have to understand, why are they making the decisions? Why are the investors making the decisions to buy at a really high clip in Q1 of 2022? And so I dug into the data again. In 2001 to 2006, which was the run up before the Great Recession, people were buying for a very different reason. People were buying hopefully low and expecting to sell high, and they were expecting to do it in a very short time period. And there's a lot of reasons behind why that became possible, but at the end of the day, you had an entire nation of real estate speculators. You had people that the most important part of the decision for them was short-term pricing. And when the rug was pulled out and the lights were turned off at the bar at the end of the night, and everybody understood that the real estate world and the lending world contributed to the massive gains in home prices and that the music had to stop, those same people that were basing their investment strategy on short-term pricing and speculating, at that point, they didn't have 5 profit centers. They didn't have an asset that could pay for themselves every single month. And they had acquired 5 or 10 of them. And then all of a sudden they couldn't afford the payments. And then they sold those houses en masse. And that contributed to the collapse and the Great Recession that we all experienced. So that's why they were buying then. That is not why investors are buying now. I looked up one data point that I think tells a very telling story. The average 30-year interest rate in January of 2005, which was like the height of the party as far as speculating in 2005, the average 30-year interest rate across the country was 5.77%. So that's low, but not crazy low. And when home prices spiked like they did, those 5.77% interest rates could not support cash flow positive investments at that time. And that's why people were speculating. Home prices went way up, call it 5.77% interest rates. You didn't produce a lot of positive cash flow in a lot of markets out there. So they were speculating. So 5.77% was January 2005 average interest rates. Pablo, you want to take a guess of what the average interest rates were in January of 2022?
Like 4.5?
2.65%.
That was way off.
You were way off, right? 2.65%, the lowest that they have been in history, okay? When you have the opportunity to borrow debt for 30 years at 2.65%, you are going to make moves to take advantage of that if you're not your average investor. Even if you're not a notch, if you're an average investor, you're going to take advantage of 2.65% interest rates. And so that is the reason why there's so much activity in Q1 of 2022. And you ask, why are those people buying? Are they speculating? Is short-term pricing the most important thing to those people? No. They're buying these assets because of all 5 profit centers. They're buying the way that we all think about it as a part of the Not Your Average Investor Show community. And short-term pricing for us is the least most important part of the decision. If you have the ability to lock up debt for 2.65% interest rates, like we all had the opportunity to do in January of this year, you buy that. And the last thing you want to do is sell it in 6 months or in a year. For all of us who are able to lock up debt anywhere around that 3%, even 4%, even 5%, that low cost of debt will make you so much more money the longer you hold on to it. So what you're seeing is we are not a nation of speculators at this moment, nearly to the degree that we were in 2001 to 2006, because all 5 profit centers are working for us now because interest rates were so low.